Imagine you wake up one morning, grab your phone off the nightstand, and see that your retirement account dropped thousands of dollars overnight. You didn't do anything wrong. You didn't make a risky investment or panic sell. You were literally just sleeping, yet the money is gone. And the trigger for this whole mess started with everyday medicine, the exact same pills you pick up at CVS or that your grandmother takes with breakfast. That one announcement about prescription drugs sent the stock market plummeting, resulting in the worst single-day crash since the COVID pandemic. Today, we are going to skip the complicated Wall Street jargon and look at the real, simple math connecting a bottle of pills to the sudden destruction of your savings. Let's look at the financial reality of April 2026. The U.S. economy is already under heavy pressure, with inflation holding above 3% and mortgage rates sitting right around 6.5%. American consumers are stretched to the limit, holding a record $1.33 trillion in credit card debt. Because of that financial squeeze, actual survey data shows exactly half of the country is living paycheck to paycheck, leaving them absolutely zero margin for error. Into this highly fragile environment, the White House drops a massive policy shock, a 100% tariff on pharmaceutical drugs. A tariff is a tax on imported goods. When the U.S. buys medicine from Germany, India, or Switzerland, the government demands a border fee. At 100%, the cost to import those drugs instantly doubles. When a major industry's costs double in a single day, panic ensues. Traders rush to sell off pharmaceutical assets, dragging the rest of the market down with them. That massive sell-off directly impacts you. If you have a 401k, an IRA, or standard index fund tied to the broader market, the value of your shares took a massive hit. To see why those traders panicked, let's scale this down to a simple business. Imagine you own a neighborhood lemonade stand. Your business model is straightforward. You buy raw lemons from a local farm for 50 cents, make the lemonade, and sell a cup for $2. You pocket the difference as profit. Now, an external authority steps in and declares that starting tomorrow, every single lemon you buy will cost $1. You face two bad choices. Option 1. You raise your lemonade prices to maintain your profit margin. Your customers get angry, and your total sales volume crashes. Option 2. You absorb the extra cost. Your profits shrink to almost nothing. Your business loses its value, and anyone who invested in your stand demands their money back. Now, scale that exact same trap up to multi-billion-dollar pharmaceutical corporations. Instead of lemons, these giant companies buy active pharmaceutical ingredients, or APIs. These are the base carbon compounds required to manufacture any finished drug. This chart shows exactly where those chemical compounds come from. 80 to 90% of all the raw ingredients needed for American medicine are imported from India and China. When a tariff instantly doubles the cost of 90% of your raw materials, the entire domestic industry becomes completely unprofitable overnight. Think about the medicines sitting in your bathroom cabinet right now. The blood pressure pill, the antibiotic, that allergy tablet you take every spring. There is a very high probability that the active ingredient inside those pills was manufactured somewhere in Asia. Then, the U.S. government announces a 100% tariff on all imported pharmaceutical ingredients. That single policy abruptly inflates the base production costs for the entire American medical industry, creating an immediate zero-sum math problem for the companies manufacturing your prescriptions. Wall Street heard that announcement loud and clear, and the reaction was immediate. Investors do not trade based on what is happening right this second. They trade based on mathematical projections of what will happen next month, next quarter, and next year. This flowchart shows the two paths drug companies take when ingredient costs explode. Corporate profits drop to absorb the expense, or retail prices go up. But rising prices create severe political risk. Sick people become angry voters, inviting aggressive new government regulations. Faced with the guarantee of profit loss and a looming regulatory threat, traders pulled billions of dollars out of major drug companies in a matter of minutes. Industry giants like Johnson & Johnson, Pfizer, Merck, and Eli Lilly all watched their stock values drop. But the selling continued well beyond the pharmacy counter. Investors looked at the aggressive action taken against healthcare and started asking what other industries the government might target next. This diagram illustrates the psychological feedback loop of a market crash. Fear sparks initial selling, which drives the underlying value metrics down. When other traders see those plunging prices, they sell their own shares, driving the metrics down even further. This is a financial panic attack, and the symptoms spread instantly across the entire market. Isolated sector volatility shuts into systemic instability when driven by pure psychological contagion. To measure the scale of that instability, look at the S&P 500, the aggregate report card for the 500 largest corporations in America. By the time the closing bell rang, the index had suffered a massive, multi-percentage point drop across the board. Specifically, it was the steepest dive the rocket had taken since the global economic shutdown in March of 2020. We are talking about the kind of red ink we haven't seen since a global pandemic froze commerce. Reaching a historical threshold indicates a systemic disruption to the economy, setting the stage for the personal consequences. A common misconception holds that only active stock traders feel the impact of a market crash. If you have worked a steady job in the US for a couple of years, your employer likely skims a percentage of your paycheck to deposit into a retirement plan. This diagram shows exactly where that money goes. Your 401k paycheck deduction is composed of index and mutual funds that are directly tied to the performance of the market. You likely opted into this when HR handed you confusing forms on your first day. Because the deposit happens automatically, you are exposed to macroeconomic shifts without even noticing. Because these funds track the broader economy, an abstract crash on Wall Street creates a direct drain on the everyday worker's life savings. Let us put concrete numbers on this. The average American worker holding a 401k has roughly $85,000 saved up. This bar chart visualizes what happens to that average balance on a bad day. During a 2 to 3% market drop, that worker watches between $1,700 and $2,500 evaporate in a single afternoon. Technically, that is only a paper loss. You do not lose the cash until you sell. But seeing thousands of dollars gone prompts terrified workers to liquidate their investments, locking in a permanent realized loss. The danger scales up drastically if you are nearing retirement age. A 59-year-old planning to withdraw funds next year physically lacks the decades needed to wait for the market to recover. Market volatility dismantles lifelong retirement plans, leaving millions exposed to an impending double hit that they never saw coming.